Have you ever considered investing in the S&P 500? If not, you might want to start. The S&P 500 isn't some secret club or complicated financial instrument. In fact, it's quite straightforward. It's a key barometer of the US stock market's performance, keeping tabs on 500 large public companies. Imagine a giant spotlight shining on the financial health of the country's largest corporations. That's what the S&P 500 does. And guess what? You can be a part of it too. By investing in the S&P 500 through exchange-traded funds or ETFs, or even through index funds, you can enjoy low costs and diversification. It's like getting a slice of the entire US stock market cake, all in one go. And the best part? You don't have to be a Wall Street whiz to do it. So are you ready to learn how you can start investing? Let's do it together. You might be wondering, why should I invest in the S&P 500? Well, let's dive into that, shall we? Investing in the S&P 500 offers a number of compelling advantages. First and foremost, it's a low-cost way to diversify your investment portfolio. Think of it as a buffet of the US stock market, where you're served a little bit of everything. This broad exposure to 500 large public companies reduces your risk because you're not putting all your eggs in one or a few baskets. Historically, the S&P 500 has delivered strong returns. Over the long term, it has proven to be a reliable wealth-building tool. While past performance doesn't guarantee future results, the S&P 500 has shown resilience through various market cycles, bouncing back from downturns and reaching new heights. Now you might be thinking, why not buy all the S&P 500 stocks individually? Well, that would be like trying to host your own buffet from scratch. It's not only costly, but also highly impractical. You'd need a lot of money, time, and expertise to manage such a large number of stocks. Instead, you can invest in the S&P 500 through exchange-traded funds or index funds, which mimic the performance of the S&P 500. They're like a ready-made buffet, offering you a taste of all the stocks in the index. Plus, these funds have low expense ratios, which means more of your money goes towards your investment, not fees. Another benefit of investing in the S&P 500 is that it includes companies that meet ethical criteria through the S&P 500 ESG indexes. So you can align your investments with your values without compromising on returns. In sum, the S&P 500 offers diversification, potential for strong returns, low costs, and ethical investing. It's a practical and efficient way to invest in the US stock market. Now that you know the reasons to invest, let's talk about how you can get started. So, you've decided to invest in the S&P 500, but how do you go about it? Well, fear not. The process isn't as daunting as it may seem. Let's break it down into simple, easy-to-understand steps. Firstly, you'll need to decide on your investment method. Two popular options for investing in the S&P 500 are through exchange-traded funds, often referred to as ETFs and index funds. Let's talk about ETFs first. ETFs are investment funds that are traded on stock exchanges, much like individual stocks. They're designed to track the performance of specific indexes, in this case, the S&P 500. This means that by buying shares in an S&P 500 ETF, you're essentially buying a tiny piece of each company in the S&P 500. It's a simple and efficient way to invest in a broad market segment. Now, on to index funds. These are mutual funds that aim to replicate the performance of a specific index, again, in our case, the S&P 500. Index funds are a popular choice for many investors due to their low fees and simplicity. Just like ETFs, they offer broad market exposure, but they differ in how they are bought and sold. While ETFs can be traded throughout the day like stocks, index funds can only be bought or sold at the end of the trading day at the fund's net asset value price. The Fidelity 500 Index Fund is a great example of a top-pick index fund. Known for its low expense ratio and strong historical returns, it's a fantastic choice for those looking to invest in the S&P 500. But how do you actually buy these ETFs or index funds? Well, you'll need to open a brokerage account. There are numerous online brokers to choose from, each with their own pros and cons, so do your research to find the one that best suits your needs. Once your account is set up, you'll be able to buy and sell ETFs and index funds at your leisure. Now, it's important to note that investing in the S&P 500 isn't a set-it-and-forget-it type of deal. You need to monitor your investments, adjust your strategy as necessary, and always stay informed about market trends and economic news. But remember, investing in the S&P 500 should be just one part of your overall investment strategy. Diversification is key, so you'll want to complement your investments with other asset classes to create a well-rounded portfolio. Before I continue with investing in the S&P 500, you may want to hit that subscribe button so you can catch all our latest personal finance tips and tricks. As I always say, the more informed you are, the more prosperous your future will be. While investing in the S&P 500 is a great move, it's important to have a well-rounded portfolio. You see, investing is like a meal. The S&P 500 might be your staple, like rice or pasta. It's reliable, it fills you up, and it's a safe bet. But if you only ever ate rice, you'd miss out on the nutrients you get from vegetables, protein, and other food groups. In the same way, you want to complement your S&P 500 investments with other asset classes. Your portfolio should include a mix of stocks, bonds, real estate, and potentially even commodities or other alternative investments. This is what we call a diversified portfolio. Diversification is like an insurance policy for your investments. The idea is that by spreading your investments across different asset classes, you can reduce the risk of any one investment dragging down your entire portfolio. It's like the saying goes, don't put all your eggs in one basket. Now, why is this important? Well, while the S&P 500 has historically provided strong returns, the stock market can be volatile. There will be times when it goes down. If all your investments are in the S&P 500, your portfolio will take a hit. But if you've diversified, the impact could be softened. For example, bonds are generally considered to be less risky than stocks. So when the stock market goes down, bonds might hold steady or even increase in value. Real estate, on the other hand, can provide a steady income stream through rental income, even if the value of the property itself fluctuates. Moreover, diversification can also help maximize your returns. Different asset classes perform well at different times. By having a mix, you're more likely to catch those high-performing investments. So, with a diversified portfolio, you are not only investing in the S&P 500, but also ensuring your financial stability. Let's quickly recap what we've learned today. We started off by diving into the world of the S&P 500, a key indicator of the U.S. stock market's performance. This index tracks the performance of 500 large public companies, making it a comprehensive snapshot of the market's overall health. We explored the reasons for investing in the S&P 500. It offers low costs and diversification, two factors that are crucial for any investor. It's also a practical option, as attempting to individually purchase all S&P 500 stocks would be costly and impractical. We then delved into how to invest in the S&P 500. One of the best ways we discovered is through exchange-traded funds or ETFs and index funds. These funds mirror the performance of the S&P 500, allowing you to indirectly invest in all 500 companies without buying each individual stock. Next, we discussed the importance of complementing your S&P 500 investments with other asset classes for a well-rounded portfolio. While the S&P 500 is a solid foundation, it's crucial to expand your investments into other areas such as bonds, commodities, or real estate for diversification and risk management purposes. We also touched on S&P 500 ESG indexes, which apply ethical criteria to company selection, allowing you to align your investments with your personal values. And we highlighted the Fidelity 500 Index Fund as a top pick, with its low expense ratio and strong historical returns. Remember, investing is a journey, not a destination. So take your time, make informed decisions, and watch your investments grow over time. Good luck!